Hello, everyone. Welcome to today's YouTube session from Impact Taxation and Financial Services. So in today's session, we want to do a very quick case study, how to save $32,000 in tax while helping children employees to purchase their first home. Okay. Before we go to the main content, a very quick declaration. The information provided here is for general guidance only. We recommend consulting an experienced tax advisor or planner before making any decisions. All right, so the key strategy we want to introduce here is first homeowner super saver scheme. Okay, it's called FHSS in the short form. So basically, for anyone who never purchased property in Australia, for their first property purchase, they can contribute to their super fund, okay, as concessional super contribution, up to $15,000 a year. And then, so the total amount they can contribute from multiple years can be up to $50,000. Okay, of course, there are other eligibility requirements. Yeah, you can double check with us or talk to an experienced tax planner in this area, okay, to find out what are the eligibility requirements you need to meet. So basically, once you do that, the contribution, concessional contribution will be taxed at 15% inside the super fund. Okay, so of course, it's going to help to reduce the marginal tax rate from outside super. Okay, and then of course, later on, the children can withdraw the money to cover their first home purchase. All right, so let's have a look at the case study. So let's say there's a family group who's operating a business under family trust structure. And then let's say if they don't have enough beneficiaries to receive or distribute profit, and then so the beneficiaries might need to pay up to 47% marginal tax rate. Okay, then in the family group, there are two children, Tom and Jerry, okay, 15 and 16 years of age, and then they're earning part-time wages from the business. And so basically, the business owner would make concessional contribution for each children at $10,000 each for 5 years, and the total contribution would be $50,000 for each child, and a combined contribution of $100,000 for both of the children. Okay, then the children, of course, later years can withdraw the money out to cover their first home purchase. And what's going to be the money they can withdraw? Okay, 100K minus 15%. So that means 85K they can withdraw to cover their first home purchase. All right. So let's assume that the children's part-time income is maybe 30K or 40K. Okay, because there will be an offset of 30% tax offset, of course, if their income is above certain level. But if their income is 30K, so basically their withdrawal, okay, from the super fund will be 100K minus the 15% that was already taxed inside the super fund, and 85K they can withdraw to cover their first home purchase. Okay, then what's going to be the total tax saving for the family group? Okay, it will be 32K, $32,000. And then the calculation is 100K multiplied by the difference between the marginal tax rate outside super of 47% and then minus the 15% tax paid inside the super fund, so 32%. Okay, so that's how the 32K is calculated. So of course, utilizing the similar strategy, as long as your marginal tax rate for the family group is going to be higher than the 15% inside the super fund, then you're going to have or achieve tax savings for the family group. All right. So this is a very quick study. Of course, there are more details you need to understand how to follow the steps. Okay, it's a little bit complicated. Yeah, we made it simple in the case study, but make sure you consult with us or an experienced tax planner to understand how to go through the steps. All right, that's everything we want to mention. Here is a brief introduction about myself, and our contact details are here. If you have any questions, send us an email, give us a call. We can also organize a session with you to discuss more details. Okay, thank you. We'll see you in our next session.